Nigeria has again called on the United Nations and international tax community to forge an inclusive, equitable, fair, and universally beneficial international tax system towards the attainment of the 2030 Sustainable Development Goals. Making the call on behalf of the country, Mr. Mohamed Nami, the executive chairman of the Federal Inland Revenue Service, stated this while delivering the Nigeria statement at the Economic and Social Council special meeting on international cooperation in tax matters held last Friday at the ECOSOC chamber, United Nations headquarters in New York. Mr. Nami noted that the Nigerian delegation is concerned about the global minimum tax as put forward by the OECD inclusive framework because of its low rate and the way it was negotiated to benefit at home, the home countries of multinationals. Well, let's understand all of this. And the right person is in the house, Mr. Abiodun Kayode Ali. Mr. Abiodun Kayode Ali is an economist and also a tax manager with PricewaterhouseCoopers. Thank you so much for your time. The traffic is crazy. Everyone in Lagos knows what is happening along the express road. We just pray that something is done to help address this. Thank you so much for coming.
Yeah, my pleasure to
really
be here.
Appreciate this. Well, governments across the world are in search of revenue, and this is something that is of major concern. But based on these concerns, a global tax solution now is what we are talking about here. Please, can you let us understand what this really means? I'm a journalist. My job is to ask the questions, let Nigerians understand what it means. Now, what does this really mean?
Okay, thanks a lot for the question. So basically, we understand that the entire economies around the world are in need of revenue at this point in time, and it's even been worsened with the impact of the pandemic, right? And so what we've seen is a situation whereby different multinational companies, they try as much as they can to take advantage of present tax structures, international tax structures. So prior to this period in the 1920s, we had an international tax structure whereby you could only be taxed if a multinational had an entity that was physically present in a local jurisdiction. So it means if you have a big multinational company in the United States, for example, before that entity is going to be taxed in Nigeria, it has to have a physical structure in Nigeria, for example, right? So we have these solutions that were being rolled out by the Organization for Economic Cooperation and Development to try and modify that system. I mean, you just think back in time. If you think about how things were done prior to this digital economy, we had things being done physically, manually, right? If you want to go to the shopping mall, you have to physically walk in to buy the products you want. If you want to use the banking facilities, you have to physically walk in, stay on the queue, receive your cash, right? But things have changed now. From the comfort of your home, you can bring out your phone, you can watch a movie, right, online, you can do a lot of things online. So as a result of this digital economy, you've seen a situation whereby a lot of multinationals can actually generate revenue without being physically present in your nation. So different nations have come together and they've thought to themselves, how come we are losing this revenue when we need it the most, especially at times like this? So different nations began to bring up their own taxation. They call it digital taxation, right? And I remember, I think in 2018 or 2019, there was a particular time when France said it was going to introduce its own digital taxation to tax the major corporates would be multinationals in the United States that were carrying on business there. And there was this reply from Donald Trump, the then president back then, right? So most of these individual measures taken by nations could lead to something referred to as trade wars, right? So in order to solve all these problems that have been created by the digital economy, as well as other nations trying to attract multinationals in their own country by lowering the tax rate, a form of incentive for them, in order to address most of all these global taxation issues, then the OECD, along with the G20, one of the industrialized group of nations, as well as other nations like Nigeria, for instance, decided to come together to form what is referred to as an inclusive framework to see how they can address most of these issues that are being caused by the digital system, and to ensure that they derive their own fair share of taxes as a result of the activities of these multinationals. So that's what led to most of these solutions that were proposed.
Interesting stuff. But how is the global minimum tax solution expected to work? And are there timelines for this?
Okay, yeah, that's a very good question. So the global minimum tax, the way it's expected to work is what has been agreed, right, by a lot of nations, or majority of those nations that formed what is referred to as the inclusive framework, the way it's supposed to work is they're expected to set a benchmark effective tax rate of 15%, right? So it's going to be a minimum, right? If there is any multinational that has its operations in any jurisdiction that has signed on to this agreement, if the effective tax rate in that jurisdiction is lower than the 15%, you are going to see a situation whereby either the home country of the parent company is then forced to pay the equivalent tax in such a way that that jurisdiction, if you look at the global effective tax rate, it is still that 15%, right? So there are two particular solutions that were proposed, right? So first of all, the home country of the ultimate parent company can decide to tax that parent company in such a way that the 15% effective tax rate is met. If the home country refuses to do it, then it then boils down to the jurisdiction in which that entity that is paying below that threshold. It then boils down to that country where the entity jurisdiction is located in. That country can then adjust the tax rate in such a way that it achieves that 15%. But the thing is that you have the home country, first of all, taking that position. Then if the home country refuses to tax, then you have the resident country taxing that particular entity in such a way that it comes up to that 15%. The long and short of it is therefore that most multinational companies, there is really no way to escape at this point in time, because if you think about it, every country is desperately in need of revenue, right? So at this point in time, I think multinationals then have to plan. They have to strategize, right? How do they want to go about how do they want to go about structuring their entities, their subsidiaries? Are there other benefits they should be looking at? And it also then boils down to countries to ensure that multinationals in their own jurisdiction, right, if they have parent companies in areas that have signed up to this solution, they just have to find a way to ensure that they don't lose tax revenues, because now it's a struggle for which country has the right to tax the revenue of these multinationals.
In all of this, there will be positives and negatives, because when you look at all ways to generate funds, always positive and negative to this. What are the positives and what are the negatives to this?
Okay, so the positives that we see, first of all, is that you have a situation whereby countries like Nigeria that didn't sign up to this particular solution, Nigeria now has to think back on, look at some of the incentives it's giving to multinationals that are going to be affected, and see if there is a way to kind of increase the effective tax rate by cutting down on some of these incentives, right? Because even though our tax rate in Nigeria for companies is 30%, it doesn't necessarily mean that that's going to be the effective tax rate because of some incentives that's been given. So it just means that local authorities now need to plan and see how they can get these taxes for themselves, rather than just leave it in the open for other jurisdictions to take. So these are some of the positives that we see, especially nations that have been clamoring for help with respect to digital taxation and international taxation. For the negatives, some of the things that we've seen is that some countries still feel that the 15% is still low, right? That it should be something a little bit higher. And a lot of developing nations, because if you look at it, in the inclusive framework, we have countries that are developed and we have countries that are developing, right? And the developing nations felt like they were cheated, right? So two nations in Africa, Nigeria and Kenya, didn't sign up to the solution because they felt, especially the first part of the solution, they felt it wasn't going to pay them, right? So a lot of these nations are looking onto the bigger developed nations to see how they can, their concerns can be addressed. So they are looking for a further increase in that 15%. So these are some of the concerns, and that's why they've not signed up to the solution. Then again, multinationals, like I said earlier, they need to begin to think about how they want to strategize themselves, how they want to place themselves in these nations. Because the truth is that even though some of these multinationals, even though they might not be paying an effective tax rate that is high, one other benefit you can see from the activities is that they are creating jobs, right? They are creating opportunities, right? And there is even that platform for them to be able to share their technology and basically improve the well-being, right? The standard of living for those jurisdictions that they stay in. So these are some of the concerns that we see.
You just mentioned something very important, that Nigeria is opting out of this global tax solution. So why are we out at the moment?
Okay, so the solution itself has two parts of it. There is a first part which is referred to as the Pillar 1, and there is a second part which is referred to as the Pillar 2. So I think based on discussions by the Federal Inland Revenue Service, they had concerns with the first pillar, the Pillar 1, right? And the reason why they had such concerns, like I said earlier, was because a lot of nations, right? Some nations signed up to this agreement involuntarily. It wasn't like they wanted to, but they were between the devil and the deep blue sea, right? So Nigerians' concerns basically was that the first part of the solution was going to be a disadvantage to Nigeria because if you think about it, the first part of the solution has to do with the taxation of the digital economy. Okay. And there were some certain thresholds that were put in place, right, that would mean that not all digital companies will be taxed, right? Not all companies will be taxed, multinational companies will be taxed. Only companies that met a certain threshold. And even when those companies meet that threshold, it's not even all their profits that will be taxed. It's a portion of their profits that will be taxed, right? And even though we say it's a portion of their profit that will be taxed, it's not everybody that will get that portion, right? So most of those thresholds and conditions seem to be unfavorable compared to what Nigeria had introduced through its Finance Act. In 2020, there was the Finance Act 2019 that was introduced by Nigeria, and it's brought in something referred to as a significant economic presence. Now, that significant economic presence had a certain threshold that would capture lots of companies that were carrying on activities at a significant level in Nigeria. Now, by the time you compare what Nigeria had introduced, that significant economic presence, to what that first solution, which I refer to as Pillar 1, introduced, it seemed like Nigeria was going to be way better off if it continued with its position, right, the significant economic presence, compared to adopting that other solution, right? And there were other stringent conditions that were not too favorable. And I think the last concern that Nigeria had was that because the inclusive framework, the OECD had predicted that the first pillar solution was going to cost about $100 billion additional revenue to governments around the world. Nigeria, the portion that was allocated to Nigeria thought about it, and Nigeria felt like for the OECD to come up with this estimate, first of all, the figures and the parameters they were using didn't seem to be realistic, right? They were using some parameters that Nigeria had concerns. Even though you see those things in our statistics, they don't necessarily mean that that's what we're enjoying, such as growth rate and those sorts of things, right? So Nigeria had concerns with those issues. So pretty much that's why Nigeria didn't sign up to it. And Nigeria is advocating, right, to the United Nations because we're part of ECOSOC, right? That's the Economic and Social Council of the United Nations, right? So Nigeria is advocating that if there are other things that can be done to ensure that most of its concerns are addressed, probably in the nearest future, you could see Nigeria signing up.
Yeah, that's what I wanted to ask. Do you see us joining anytime soon? Considering looking at our revenue challenge, because we really have big issues with revenue. Just yesterday, we were excited that our crude oil production hit 1.6 million barrels per day, and that sounded good. So do you see us coming on board anytime soon?
Yeah, so actually, if you look at Nigeria's macroeconomic indices, right, apart from what you just said, you know, debts are rising for 6.25 trillion, right? Budget deficits 21 trillion, and even the what's it called? The Director General of the Debt Office also alluded to the fact that our debts are increasing and there's a problem with revenue. Do I think Nigeria would sign up anytime soon? No, I do not think so. I think Nigeria is still confident that its tax most of its tax policies being introduced by the Finance Act, it still believes that it can generate way more for now. So what Nigeria is just trying to do is just to take the wait and see approach, see how things turns out, because the implementation is going to start in 2024, though some nations can begin subsequently, like 2025. So Nigeria wants to take the wait and see approach, see if it works out for other people before it goes into it. But in the shortest, in the nearest 1 to 2 years, I don't think Nigeria would want to sign up to a solution.
We're always doing that. The FCFTA too, we did that. We had to wait. We had to check back before we. But finally, on a lighter note, many talk about improving our tax to GDP ratio, and that's been something that I don't know. With the knowledge I have, I think there we used to say is about 6, 7,
yes, that's correct.
6% or something.
Yes.
So with something like this help increase that, or what can we really do to help push that up? Because you see some African countries not doing as well as we are doing, and the percentage of tax to GDP is about 12-15% over there.
Yes, that's quite correct. Even recently, PwC has been advocating for Nigeria. There is potential. We see potential for Nigeria to increase it to as high as even 16%, right?
Wow.
But there is a lot of things that need to be done, right? With respect to advocacy, with respect to stakeholder meetings, because if you look at most of the surveys that have been carried out even by PwC, you discover that a lot of people are reluctant to pay taxes because they can't see the output, the outcome of what their contribution is doing, right? With respect to infrastructure, road, power, and even you talked about traffic, right? Yeah. Lots of things that are still outstanding. So people are not willing, the willingness to pay tax. And even by the time they do pay the taxes, there is also that trust. Do people trust that government will use it effectively? Do people trust that the tax authorities would actually relay it back to government coffers, right? So there's that trust deficit gap that needs to be bridged. I think a lot more needs to be done, and the new administration can begin to think of some of these things in order to increase the tax net. These are some of my thoughts.
Interesting conversation as usual. There, I've been speaking to Mr. Abiodun Kayode Ali. He is a tax manager, economist with PricewaterhouseCoopers. Thank you so much. Like I said again, I appreciate your time despite this traffic, coming live to the studio.
All right, thank you, Tolu.
All right.